You're about to make a financial decision. Maybe you're looking at a stock that's down 40%. Maybe you're watching a hot asset climb and feeling that familiar pull in your chest. And in that moment, you are convinced, absolutely convinced, that you know what's going to happen next. That feeling, that certainty, that's not confidence. That's your brain lying to you, and it's been doing it your entire life. The human brain was not built for investing. It was built for survival on a savanna 200,000 years ago. It was built to avoid predators, find food, and stay close to the tribe. And those instincts were brilliant for that environment. But the stock market is not a savanna. And the same wiring that kept your ancestors alive is quietly, systematically destroying your returns. Let's talk about what's actually happening inside your head and why the smartest investors in the world have learned to treat their own mind like the enemy. The first thing you need to understand is something called loss aversion. This isn't just a preference for avoiding losses. It's a neurological reality. Studies in behavioral economics, most famously the work of Kahneman and Tversky, found that losses feel psychologically about twice as powerful as equivalent gains. Losing $100 doesn't feel like the opposite of gaining $100. It feels twice as bad. That asymmetry rewires how you make decisions in ways you don't even notice. Here's how it plays out in real portfolios. You buy a stock at $50. It drops to $30. Logically, you should ask, would I buy this stock today at $30? That's the only question that matters. But that's not what your brain asks. Your brain is anchored to 50. It's waiting to get back to even. Not because 50 is a meaningful number in the world, but because 50 is where your pain started. And so you hold, and hold, and hold, waiting for a recovery that may never come, while better opportunities pass you by. This is called the disposition effect, and it is one of the most well-documented wealth destroyers in all of investing research. Comment below if you've ever held a losing position way too long, just hoping to break even. You are not alone. Millions of investors do this every single year. Now let's talk about the other side of the same coin, what happens when things are going well. When a position is up, that same loss aversion kicks in, but in reverse. Now you're terrified of losing your gains. So you sell early. You lock in a modest profit and congratulate yourself, while the stock goes on to double again. You got scared of losing what you had, so you never got what you could have had. The math on this pattern over a lifetime of investing is brutal. You cut your winners short and let your losers run. The exact opposite of what builds wealth. There's another cognitive trap that's even more insidious because it masquerades as intelligence. It's called confirmation bias, and it operates like an invisible filter over everything you see and hear about your investments. Once you own something, your brain starts unconsciously seeking information that confirms it was a good decision. You read the bullish articles. You find the analyst who agrees with you. You dismiss the bearish case as uninformed or biased. You are no longer doing research. You are building a legal case for a verdict you've already decided. The really dangerous version of this happens with investors who are also highly informed. The more you know about a company or an asset, the more attached you become to your thesis. The more attached you are to your thesis, the harder it becomes to update it when facts change. Smart people are not protected from confirmation bias. In many cases, they are more vulnerable to it because they have more knowledge to selectively filter. What's the practical counter move here? Write down your investment thesis before you buy. Be specific. List the conditions under which you would sell, not price targets conditions. What would have to be true in the world for this investment to stop making sense? Then check those conditions periodically, not the price. The conditions. This one habit separates investors who think clearly from those who just react emotionally. Here's something most financial content never mentions. The market is a confidence machine. Not because confidence is good, but because the market creates confidence at exactly the wrong moments. When prices have been rising for months, when everyone around you is making money, When the news is full of optimistic forecasts, that's when you feel most certain. And that certainty is a signal, not a green light. A warning. Psychologists call this recency bias. Whatever has happened recently feels like what will continue to happen. A rising market feels like it will keep rising. A crashing market feels like it will keep crashing. This is why retail investors, on average, buy near peaks and sell near bottoms. They're not stupid. They're human. They're responding to how the recent past feels, which is exactly the input the market rewards you for ignoring. What's your biggest investing mistake that was driven by recency bias? Drop it in the comments. I think the answers will be more educational than anything I can say here. Let's get into something called the overconfidence effect, because this one is personal for almost every investor who has ever had a good run. Research consistently shows that the majority of investors, amateur and professional, rate themselves as above average. Mathematically, that's impossible. But psychologically, it makes perfect sense. When your investments go up, you attribute it to skill. When they go down, you attribute it to bad luck or external factors. This asymmetric attribution creates an inflated sense of your own edge. The most dangerous investor in the room isn't the one who knows nothing. It's the one who had a great year in a bull market and now believes they've figured something out. Because that person starts taking concentrated bets. They start ignoring diversification. They stop questioning their assumptions. They've confused a favorable environment with personal ability, and the market will eventually show them the difference. Here's the insight that reframes everything. Volatility is not your enemy. Your reaction to volatility is your enemy. The market has always recovered from crashes. Every single one. What it cannot recover from is a panicked investor selling at the bottom and locking in permanent losses. The math of a temporary 40% drop is survivable. The math of a 40% drop that you crystallize into reality by selling and then miss the recovery is not. This is why the most powerful investing strategy isn't finding the best stocks. It's engineering your environment so that your brain doesn't get the chance to make panic decisions. Automation helps. Setting rules in advance helps. Not checking your portfolio every hour absolutely helps. You are not building discipline by white-knuckling through every dip. You are building discipline by removing the moments where your brain gets to vote. And this brings us to the deepest insight about behavioral finance that almost nobody talks about. Self-awareness is not enough. Knowing about your biases does not make you immune to them. Research by Kahneman himself, the man who literally wrote the book on cognitive biases, acknowledges that he still makes the same mental errors he spent his career studying. Knowing the name of the trap does not stop you from stepping in it. What actually works is process. Checklists before you buy. Written criteria for selling. Scheduled portfolio reviews instead of constant monitoring. An investment policy statement that you wrote during a calm moment and commit to following during a chaotic one. The goal is to make your present self honor the commitments of your calmer, more rational past self, because that version of you was thinking more clearly. Tell me in the comments, what's one rule or system you use to keep your emotions out of your investing decisions? Seriously, the best answers in this community come from people sharing what actually works for them. The enemy isn't the market. The enemy isn't inflation, or interest rates, or geopolitical risk, though those are all real. The enemy is the 6 inches between your ears. The pattern-seeking, loss-fearing, overconfident, recency-biased, story-building machine that you carry with you to every investment decision you ever make. The investors who win over long periods of time are not the ones who feel nothing. They feel it all: the fear, the greed, the certainty, the doubt. They've just built a system that makes those feelings largely irrelevant to the outcome. They've accepted that their brain will lie to them, and they've stopped asking their brain for permission before acting. That's not a trick. That's not a hack. That's the whole game. And now that you know what you're actually up against, you can start playing it differently. VidIQ Sonnet 4.6 low.